Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com, and I'm excited you have joined me today. Today, we are going to talk about how to diversify your real estate portfolio, especially in 2025, for maximum protection. So we've been working our way through how to respond to these volatile markets. First, with building our fortress balance sheet. Next, by understanding how to invest in market downturns. And now we're stepping it up a layer and trying to look at diversification. All right, what does that actually mean? But before we dive into that topic, you're in the right place if you want to turn your active income and savings into passive income and long-term wealth. Maybe you've tried to invest in passive real estate before and just couldn't quite get comfortable with the investment. You didn't understand it. Or maybe you actually invested in a deal before and you realize, oops, I did a ready, fire, aim situation and maybe made a mistake. Or you are a seasoned passive investor and you simply want to level up your skills. If that's you, you're in the right space. So a little bit about me, if this is the first time we're meeting. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com, and I walk the talk. I have invested in over $800 million in real estate actively. That does not include my passive real estate holdings. I've done fix and flips, single family buy and hold, small multifamily, larger multifamily deals, self-storage, express car washes, and this has been since 2002. So I've walked probably most of the investments that you guys personally probably have done. I also am the author of the book, Money for Tomorrow, How to Build and Protect Generational Wealth. And so a lot of these teachings are incorporated in that book, but most importantly, that book walks you through the journey in my evolution on how I scaled my portfolio. And we tap into many of those topics here on the Passive Investing Made Simple Masterclass. Now, all of this is to say, in scaling this portfolio, it's not for numbers' sake, it's not for vanity, it's to achieve one result, and that is to get 100% choice and control on how I spend my time, how can I be location independent? How can I create an impact in the world? And for me, I want to, do a lot of traveling. So you see me and my crazy crew here, but I also love spending my time with you guys, showing you how you can leverage passive real estate investments, passive investments in general, in order to build cash flow and also create equity growth and maybe pepper in some tax benefits there. So we can actually help you do that here at PassiveInvesting.com. We have over 2 billion in assets acquired, 1.5 assets under management, over 400 million raised in our fix and flip debt fund. And if you want to learn more about what we do here at PassiveInvesting.com, be sure to join our Passive Investing Club. You can scan the QR code on your screen or join me at PassiveInvestingWithWhitney.com. There you get access to our open deals, a one-on-one call with either myself or our investor relations team to understand your investing goals and how we can best help you. And then, of course, all the wonderful education that we put out here. Now, today we're going to talk about diversity. We are going to get into a little bit of numbers, but none of this is financial advice, legal advice, tax advice. It's all education. So make sure to take this all back to your investing team before making an investment decision. All right. So again, we've been kind of layering on skills. I really started off this series of webinars in April, not with what's happening in the markets in mind. Okay, now a lot of us have like memories of goldfish, so to speak, to borrow a term from Ted Lasso, if you guys have ever watched that TV show. When the going's good and the going's going up, we're like, ooh, we can kind of like shake it off. But the thing is that I would imagine we're going to continue to see this volatility. Why is that? Well, we have this undercurrent of tariffs still kind of looming over our heads. We also have, the tension between the administration and the Federal Reserve. The administration really wants to drive interest rates down. The Federal Reserve is holding steady. The Federal Reserve Chair is not slated to be replaced until May of 2026. So we need to learn how to, one, fortify our foundation. That was what we were doing in our Fortress balance sheet presentation early in April. We need to learn how to invest through market downturns and volatility. That's what we were tackling over the past couple weeks. And once we start having those two key foundational skills in place, now it's like, how do we start growing our portfolio and keeping diversity in mind? What does that word even mean? So in the run-up from about 2015 until 2021, I think a lot of people, including myself, said diversifying in the market when it's going up. Really simply, you just have to answer these questions on the screen. Do you believe in real estate? What are your goals, risk, and timeline? Your portfolio diversification, you just need to look at asset classes, operators, markets, and deals. If you can answer all of those pieces, if you're tracking all those pieces, you're golden. But here's the thing, that model alone assumes that the limited partner understands the interplay between their goals, risk, and timeline and the assets they're choosing. Okay, there was a kind of an underlying, an assumed skill here that that I think we all thought that we all had, that limited partners could automatically pick out. But here's the thing, that wasn't really the case, okay? Because a lot of us have been, our portfolios might have been suffering in the past few years to either low distributions, no distributions, maybe even some capital calls, or maybe, there's asset distress. Heaven forbid you uncover that you're now part of a Ponzi scheme. We're seeing a lot of that in the marketplace. And so this original training around diversification, meaning that as a limited partner, you're golden as long as you're diversified over asset classes, markets, and operators, that didn't afford us enough protection, right? Because we made an assumption, okay? Here's the thing. What has this left us with? There's a lot of psychological barriers, right? It's kind of like, if you harm an animal, they're going to shrink away from you. If for me, as an investor, if you hit some of these losses, if you don't know how to spin that around and learn from them, what we end up with is fear, hesitation, analysis paralysis. We move from abundant thinking to scarcity thinking. We move into, maybe it's not even that like black and white. Maybe you're just kind of like in a wait and see, holding pattern approach. All of this equals to missed opportunities. But here's the thing. As investors, nobody's going to ring a bell and say, ding, 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 it's time to invest now. So again, we have to learn these skills. One, how do we build the Fortress balance sheet? Number two, how do we actually build out our 3-tier investment model that is what we termed an all-weather portfolio for passive real estate investors? And then we're moving into the 3rd tier. How do we diversify moving forward? Okay. Well, one, we still have to answer the question for ourselves, okay? If we assume that you've got all of your Fortress balance sheet taken care of, you got your tier 1 investments laid out, which we'll touch on, recap you guys here in a second. You've built out that tier 2 model, which is your cash flow model, right? And you're looking at your tier 3, which is kind of your growth arm of your portfolio. You have to ask the question, was in our original diversification question, do you still believe in real estate? Well, the thing is, even in today's market, even in a volatile market, real estate still is one of the most powerful investments you can make because it can offer cash flow, appreciation, equity growth, leverage, tax benefits, okay? Something that you can't get in the stock marketplace, okay? But here's the thing, okay? We as passive investors have to learn how to use real estate wisely, meaning we shouldn't try to allocate 100% of our portfolio to one asset class, okay? And make that one asset do everything for us, meaning it's meant to bring in all of our cash flow, provide all of our growth, all of our leveraged growth, and then all of our tax benefits, okay? We shouldn't do that. We should, again, divide up our portfolio appropriately, Okay, so that brings us to tier 3, our deploying capital. All right, so before we get into diversification specifically, when we look at deploying capital, we still have to understand the time horizon. Okay, where are you? Okay, are you like really within 5 years of retirement? You can't take any ups and downs in the market. Then maybe you're in the cash flow phase. Maybe if you're 5 to 10 years away from from retirement, you can have part of your portfolio in equity growth, maybe another part in cash flow growth. Okay, some combination of the two. That's a transition phase. Maybe you're, say, 10 plus years out. Okay, you have time to make adjustments in your portfolio before you need to start moving those assets into cash flow. Then I would call that the accumulation phase. The second question is, what do you want? Okay, I have a comment here at the bottom of the slide. Is never copy another investor's investment strategy without first understanding your own. I've seen more investors in investment groups lose hundreds and thousands of dollars because they followed somebody else's investment advice as opposed to really sitting down with these questions here and understanding their own. So what do you want? Okay. Cash flow, equity growth, diversification. Is it a blend of those? Which I argue it always should be a blend of those. Okay. Number 3, really get clear on your appetite for risk. Okay. I think a lot of investors, myself included, thought that we were in super low risk investments when you take a step back and you understand and you look at the capital stack, we might have been in the highest common equity, highest risk, highest reward asset class. Okay, so really take a step back and understand your appetite for risk. And again, this doesn't have to be black or white, meaning you're willing to take on risk or no risk. Maybe you allocate, again, a portion of your portfolio, like our tier 1, which is meant to cover our 6 to 12 months of reserve. That's no risk. That's off the table. Then we've got our middle part, tier 2 of our portfolio, our ground floor, which is just meant to provide cash flow for us to smooth the volatility ride. Okay. And then we have a certain part of our portfolio that we'll put in moderate risk investments, and then maybe you shoot for the moon on development in the other part of your portfolio. Okay, so understand and create an allocation for risk. And then number 4, look simply at what the marketplace is giving you. Okay, I think this is super challenging for limited partners. I have talked to several limited partners over the past year that might be having an equity event. Say they liquidated some stock options from work. Awesome, the markets are super high, great time to do that. But now they need to invest, or that's what their strategy is invest in an equity asset to get the tax benefits, okay, to kind of lower their tax bill. Okay, without understanding that they have to have all these other key pieces in place, okay, and that the market right now is giving them debt and debt-like investments, right? So there is a cost to misunderstanding diversification, right? We've already alluded to in the past like 2 or 3 years, simply being diversified in asset class, market, and operator just wasn't enough protection. And why was that? Is because for most people in passive real estate, they keyed in on the focus of common equity, maybe peppered in with a little preferred equity, okay? So they were super exposed to just one layer of the capital stack, okay? And we want to limit that. That is our job moving forward, is to learn and make adjustments. That way, when the next cycle comes, because it's not a matter of if, it's a matter of when, our portfolio provides a much smoother ride. So what does that look like? So these are kind of like what I call the new rules of diversification, okay? And we touched on these a little bit last week, okay? This is, but we put it in terms of how do you build your all-weather passive real estate portfolio, okay? First, you got to lay the foundation, all right? Maybe it's a crawl space, maybe it's a basement, but we're building a house. We got to lay the foundation, okay? Maybe it's even just a slab, all right? And that's understanding the reserves in your liquidity that you need to have for the next 6 to 12 months. That's cash that we are going to keep super duper safe, super duper liquid. Okay, we're not going to put it in any risky asset that could be exposed to the market volatility, that could go up and down and bounce around on us. Okay, I'm talking about high yield savings accounts, maybe some money market accounts, maybe some cash value life insurance policy, like a whole life policy, not a universal index policy. Okay, something that we can get very stable, very accessible. And then we're going to build our ground floor, okay, our tier 1 assets. Okay, these should be low risk, like a first lien position, liquid income play. Okay, very plain Jane vanilla, no leverage to use on these type of assets. Okay, we're not going to invest with operators that use leverage on their debt portfolios to juice their returns, because what does that do? If we're not in first position anymore, we're now behind a bank line of credit. Okay, we're going to keep this super plain Jane vanilla. Okay, this is going to give us ground floor, some tier 1, maybe like upper tier 1 cash flow, most likely our tier 2 cash flow hybrid, flexibility layer. And then we can layer on top of that cash that we don't need for, like, say, a year or 3 years. Okay, but we're going to keep it secured. We're going to keep it semi-liquid, very low volatility. Okay, we're going to build out the second layer. Okay, now once you have 6 to 24 months in these 2 layers, okay, and that's all personally dependent on your needs, then it's now the time to start figuring out what do we have left over to deploy into the growth layers. Okay, but what we've done here is we've created diversification across the different layers of the capital stack, and they're going to respond different under different market conditions. Okay, the foundational layer in an up market when interest rates are down might not provide that much cash flow, but it's going to give us a sound foundation and sound cushion. But when the market comes down, credit leaves the system, the cash flow layers of our portfolio, the foundation and the ground floor, and maybe even the second floor, the rates on those are going to go up. Okay, and we're going to get a higher return. So again, we want to build a portfolio that's going to respond to different market cycles differently, different parts of the market cycles differently. All right, now once we understand our diversification, our goals, risk, and our timeline, understanding the different layers that diversifying across what our tiered portfolio and the different layers of the capital stack. Now we're going to get to the upper part, the common equity and the preferred equity. All right, this is where the old advice, okay, what we used to say that all limited partner had to do, that advice still applies. Okay, this is where you're going to look at your different holdings and make sure that you're diversified across markets, asset classes, operators, and the deal. Okay, and most importantly, decide ahead of time what you are wanting to have exposed to different areas. Meaning, let's say you've got $10 million deployed into common equity passive real estate. Okay, I'm just using that so we can create some round numbers. And for you, the risk you can't afford to lose. You would lose so much sleep if you lost more than, say, $1 million of that, or if $1 million stopped distributing for whatever reason. That means you're going to keep your 10%, your allocation into each one of these tiers at 10%. Okay, that way you're not exposed. You're not going to have more than 10% weighting in any one geographical area in case it gets hit by a hurricane or a natural disaster. You're not going to have no more than 10% in any one asset class. Okay, in case it suffers a systemic, like, interest rate environment risk. Not any more than 10% with any one operator, in case that, there's an issue there. Okay, and also we try to limit our risk with our operator, and then no more than 10% with any one deal. Okay, deals, not all deals will perform as a limited partner. I am in a community here locally where I live, and I am blessed to be around some investors that have been investing in private equity real estate for over 40 years. and they will show me their portfolio. They call them their winners and losers and the super duds. And even them, they will say, you know, it's just a matter of how long you're in the game and when you're going to have an issue. It's kind of like holding your own private real estate. It's not a matter of if you're going to have an eviction, it's a matter of question of when. Okay. But this requires you as a passive investor to track your numbers, track your portfolio, okay, and adjust your allocation periodically. Now, we will deep dive into portfolio tracking in one of our boot camps here in the next couple months. You can also go to our passiveinvesting.com YouTube page and look up a previous video if you want to understand tracking. All right, so what have we covered today? Okay, first of all, again, you got to get clear on your goals, your risk, and timeline. Okay, when we're talking about diversification, I know I keep coming back to those, to those three basic moves, but when you're outlining your diversification in your portfolio, that's super critical for you to do. You have to audit your portfolio by the capital stack position. So if you have all of your investments tracked, I want you to go in and put them in allocate them, create a column and say, okay, this is a foundation investment, meaning it's just cash for my reserves. I want you then to go in next and say, okay, this is a senior debt position, no risk at all, or very limited risk associated with it. This is a mezzanine or a secondary debt position. Okay, this is a preferred equity position or a common equity position. So insert that column into your tracking spreadsheet. I would imagine most people whose portfolios have struggled over the past few years, you're going to find that you're super light on your foundational levels in the capital stack. Okay, so number 3, flag those liquidity gaps. Okay, make sure that you've got those 6 to 12 months worth of reserve set aside, that you've got some portion of your portfolio strictly for cash flow. Okay, identify those liquidity gaps and start rebalancing your portfolio now. Okay, in preparation for a market recovery, but also in preparation for the next downturn. All right, guys, we're going to open up the floor to some Ask Me Anything questions. But this is your invitation to join our passive investing club. Again, you get the priority access to our open deals, a one-on-one call with me or somebody else on our investment team, and then amazing educational classes such as these. All right, guys, make sure to scan the QR code or visit passiveinvestingwithwhitney.com. All right. For those of you who are still alive, we're going to try to keep this, depending on, I shouldn't say depending on our questions. If the questions are relevant, we're going to, continue to record the Ask Me Anything session. That is something that you guys have requested. But I want you to go into the chat, okay? Before people start dropping off, don't drop off yet. I want you to go to the chat, and I want you to tell me one thing you are going to implement from today's conversation, okay? Once you do that, you can go. You can peace out. You can take off. But if you have questions, I want you to go in there and ask those questions too. It is super important that we don't digest information just to digest it and hear it, because the likelihood you're going to take action on it is minimal. If you at least say one thing that you learn, an aha, a breakthrough, and how you're going to implement it, you're so much more likely to implement this into your portfolio. What was the last bullet on the slide after the second floor? Great question, Michael. Let me scoot back here. So what we were talking about here, as far as like the different floors, is so we need to build a foundation. Okay, so essentially your reserves. Okay. So you're going to calculate your burn rate, which means you need to be tracking your income and expenses. Most high net worth people don't track their income and expenses, or if they do so, it's super loosey-goosey. But we need to know that because we need to know your burn rate. Once we know your burn rate, then it is going to be easier for you to build a foundation for those reserves and liquidity. Okay, then you're going to have your ground floor. Okay, senior debt positions, super simple cash flow. Okay, no risk, no leverage associated. You're not trying to, get a 10 or 12, 13% return on this cash flow in this tier. Okay, you're not trying to juice it with ground up development. You're trying to keep it really simple, methodical, predictable, safe. Okay. Then we can level up into like our hybrid tiers. Maybe you're in a debt fund that, has like, construction debt in it, or maybe you're in second tier debt, like a mezzanine debt or a preferred equity note, like our PIK yield fund. Or sorry, not preferred promissory note fund, like our PIK yield fund. That would be the mezzanine debt position. And then the upper floors, that's what I said. That was the last bullet. These are going to be your preferred equity and common equity positions. Higher risk, higher reward. Okay, these are your lower floors. We want to keep them liquid and not locked up. Okay, like senior debt, we want that pretty liquid. You'd be able to get at it in under 90 days, maybe even under 6 months, max a year. Mezzanine debt, we don't want long lockups there either, maybe like a 24, 36-month lockup. Okay, hopefully less. This is the other thing that kind of nagged people, right? They were all in the equity. They expected one investment to do everything for them: cash flow, appreciation, tax benefits. They wanted the whole gambit. I get it. I did the same thing. But also, you lock up your equity for 5, 7, 10 years. Okay, so it's hard for you to make maneuvers. Okay, that has a time and place in our portfolio, but we got to have the lower floors first. Somebody said I need to organize my investments based on the risk level. Yeah, so the risk level, capital stack, right? We need to create that greater diversification in here. Okay, in order to be able to be more responsive to the environment we're in. Should I limit the percentage in multifamily, shopping center, self-storage, along with area of country, and limited number of deals with operator? So that goes to our next level of diversification right here. I think this is, most people skipped the capital layer diversification. Okay, a lot of investors that I've talked to, they were all in equities. Okay. Once you have those layers built, then when we're looking at the equities, this all applies: market, asset class, operator, deal. So that percentage is going to be dependent on what kind of risk you're willing to take. For me, I usually think about how much of my portfolio, I don't want to overcomplicate my portfolio, right? I don't want to create 100 K1s for my tax preparer, but I want to think about like, how much of my portfolio do I want to expose to one geographic market? I learned this lesson, what was it, 2021, whenever we had the big freeze in Texas and a lot of the power grid went down. Now, a lot of my assets recovered. Every one of the assets recovered, but I was like in Houston, San Antonio, Dallas, Fort Worth. I had a lot of assets in Texas, but I thought pretty spread out. The power grid goes down, cash flow went away, all these repairs had to happen. And so I just recovered from COVID. I went right into the power grid situation. And that's when I went, ooh, ding, ding. Like, I need to think about different areas in the United States, okay, with my equity investments. I need to spread out that risk, okay? Especially when I'm investing passively, okay? If you have active holdings, like you're buying your own multifamily, your own self-storage or whatever, that's a little different. I wouldn't necessarily recommend that, but passively, you're going to be able to do that. Also, look at the different asset classes, okay? You don't have to go too crazy with multifamily, self-storage, express car wash, residential assisted living, mobile home park, all of that land banking. You don't have to get that crazy, okay? Maybe pick like 3, maybe 4 asset classes, okay? Get some diversity there. But just remember, in the equity stack, all those asset classes are going to be exposed to interest rate risk. Insurance going up, taxes going up, okay? And we had the perfect storm here in the past couple of years. All right, so just to understand, okay, what it is. And I would also say, when you're just starting out as a passive investor, your concentration risk is the greatest. Okay, just like if you were buying your own single family property or your own small multifamily building, when you're just starting out, that concentration risk is the highest. So think about how you're going to deploy capital into multiple investments, say like in the next year, and create a plan so you kind of start divvying up some of that risk. Let's see here. Somebody said, great presentation as always. I agree that diversification is extremely important, both in the capital stack and with operators. I'm looking forward to receiving your book today. Oh, yay, money for tomorrow. Take it on your trip. And yes, if you would leave me a review, I'm on a mission to get 100 reviews on Amazon for my book, Money for Tomorrow. That's kind of like the magical number for the algorithm on Amazon. So guys, if any of you have read my book, definitely check that out and leave me a review on Amazon. That would be amazing. Let's see. Some people from the LinkedIn said debt is so hot. It'll be over popular and can see the decline soon. Do you agree with it? Oh, I don't know about that. I mean, it seems like there's a wealth of context that's missing from there. The type of debt that I'm in is fix and flip real estate debt. That is something that banks traditionally don't take on. And the project people have always needed this type of lending. I used to use this type of lending when I scaled my portfolio. I don't see that going away. But as you know, if somebody's debt offering is replacing bank debt, and when the banks do enter back into the picture, I can imagine that debt fund drying up for sure. But I think debt has the position in people's portfolio. I think it's, to what kind of debt they're investing in. That's a definite question. For me, I'm always asking the question, I had to, enter in, I actually had to add a criteria. I'm looking at investments over the next 12 to 24 months that are going to, let's say there's a true default or a soft default on the US dollar, or I'm sorry, on the US debt. What happens? What happens if de-dollarization happens? Okay, what assets are going to survive that? And then I take a look at, now I have to look at what happens if these tariffs actually go into effect? Okay, I come back to real estate, this capital stack in real estate almost every single time. It is going to be the most resilient in those three scenarios that are, one of which is probable, another which is somewhat likely, and the other one is kind of like, we don't know if it's going to happen. Okay, I don't mean to be a Debbie Downer, but again, we're trying to create the portfolio that's going to respond and thrive in these type of environments. We're not trying to do a crystal ball and go, ooh, what's the next best thing? Okay, that's where we're going to get in trouble. The context of the question is there's no good property to deploy the debt and it's dragging the return. I don't think that's true. Property is continually, now we got to get the more property on the market, but I think what we're seeing actually is more property trading hands off market, because a lot of people whose debt is coming due here, they can't get it refinanced, right? The banks aren't really playing ball with a lot of people. I mean, they're working out those people who have already raised their hands saying, hey, we need a workout. They're already in conversation, but there are a lot of people whose debt is coming due and they haven't even started trying to refinance it. So property's aging. Okay, our construction starts have dropped, so we're going to continue to see aging inventory. Debt cycles, just like equity cycles. I'm not sure. I would have to see. I'd have to have more clarity in order to be able to fully comment on that. I don't know if I buy that fully, actually. All right, guys. If you have any more questions, drop them in the chat or the Q&A box. I'd love to tackle those. But more importantly, if you are interested in how we can help you meet these investing goals, especially as you're shifting your portfolio and diversifying your portfolio, reach out to us at passiveinvestingwithwhitney.com, or you've got my email here on the screen.